we're dinosaurs. We love the industry and love what we did, but we're value guys, and there is not a lot of value out there. So with my own capital now, I'm looking for value. We bought the largest car wash business. This is 2006, so that's a flavor of the day now. But there's a business called Mr. Car Wash, which is a public company in the United States now. We're actually the first investors in it. There is no value. It doesn't exist. Even the businesses we acquired, they were imperfect. They had shitty systems, shitty management teams, some crappy reporting. Those businesses, you had to pay a price for all the work that you were going to do to improve it, and you would have to pay that up front. And so what ends up happening is you don't acquire those value type investments anymore. You acquire a business that is, you frankly just, you may as well pay up for the incredibly awesome asset. I grew up in Canada. Went to undergrad in a school called Queen's University, which is in Canada, in between, right near, a couple hours from Toronto. Moved to New York for one of those crazy analyst jobs where you just work all the time and become intimate with Excel, Lehman Brothers, and this was like 1997, so an incredibly long time ago. And then I had always been fascinated by investing. There was a firm called Onyx Corporation, which is a pioneer of private equity in Canada, frankly, in North America, that had just created a lower mid-market investment arm called ONCAP, which was just a shitty acronym for Onyx Small Cap Fund. Onyx had been around since the mid-'80s and had a fair amount of success. And they realized investing $10, $20 million in a business and doubly tripling it or whatever the number was, wasn't going to move the needle. But they had a legacy network of relationships and a capability and a belief that there was an interesting investment opportunity in that lower mid-market. And so as opposed to vacating it completely, create something called ONCAP, which I joined with 3 other individuals in January of, effectively late 1999, January of 2000. And I was there myself and the group, and we built the organization. I was there for 22 years. It was a super fun ride. Got to see the institutionalization, professionalization of the traditional private equity asset class. We were fortunate that we were good at what we set out to do. I think that was just a fear of losing money, a good, smart group of people, and an amazing tailwind behind us that really helped out. I think there's a lot of guys in private equity who did sort of buyouts or sort of more mature private equity investing during that time frame who think they're geniuses. And the reality is it was, there's an enormous amount of work. There's an enormous amount of risk, but it's a rising tide floats all boats. And there was just a great tailwind of interest rates going down, inefficiency of a market becoming more efficient. And so it was an awesome ride. We built over the time I was there, we had 4 funds. We were always purposely constrained the size of the business. There was never going to be a $5 billion ONCAP fund because that was Onyx. So we always knew we wanted to incrementally grow and stay somewhat in our market. Because I think if you grow too quickly, if you go from 200 to 500 to 1.5 billion to 3 billion, you completely change your network of deal sources and the network of businesses and what you need to bring to a business. So we always stayed in that 400 to sort of $1 billion range. It was 400, 600, 800, 1 billion. And over 20 years, we built 30 platforms to 150 add-ons. We had great returns. I think Fund 1 was 4x, Fund 2 was 4.5x, Fund 3 was 4.3, Fund 4 we'll see. And I left at the end of every fund is a decade commitment. And for 4 funds, I couldn't imagine doing anything else. But for the 5th fund, I couldn't imagine doing it again. And I let the guys know that we, as part of succession planning, well in advance, because I couldn't just leave. There was a lot of unwinding. It was a key man in the firm, and it was tied up with a whole bunch of transactions and businesses I oversaw. And so it took a while to unwind all that. Yeah, but I was formally out of there I guess mid 2022. And now I do a bunch of things. I, myself and a partner, we have acquired with our own capital a couple of lower mid-market businesses, not too many, because the thing I learned in my own life was if you sit on too many boards at too many places, you're shitty at what you do. So we're being pretty concentrated in where we spend our time. And that's sort of like the player, side of it. And there's the coach side of it, where I still sit on a couple of investment committees and advisory boards for young guys who used to work for me, who've started independent sponsors or independent firms. and it keeps me. I call that the coach side. That's kind of fun. Keeps me in the game. I get to kind of read memos, give some advice. Don't pay any fees on their deals, but they do all the work. So it's a fun mix.
That's awesome. So let's go back to the first fund. So when you started, was it ONCAP? You said,
Yep.
it was a brand new, so you just started, you just raised, a fund. What was the size of that fund? And what was
There was
the size?
actually, yeah, it was like the fund one was 400 million Canadian.
Okay.
And this shows how weird the market was. This is 1999. So what happened is this larger organization, Onyx, had said, look, all the things that built Onyx, Onyx is a large publicly traded company in Canada. We can't do anymore. They're too small. So they said, but we still want to do it. So they raised a pool of capital called ONCAP, which actually was raised without a team, which shows how messed up it was the pedigree of Onyx, and it also spoke to an inefficient market. So that was a $400 million fund. Onyx put up 100 million, and they raised 300 from a bunch of Canadian banks and Canadian institutions predominantly. And that fund was we made 6 platform investments, all Canadian businesses, because that was our network and our legacy at the time. After that, everything became more US. But at that time, there was only 4 of us kind of running around, and we had to spend time. And our deal flow, our networks were a bit more Canadian oriented. And there was also an inefficiency in the marketplace in Canada back then, where I'm never going to say it was easy. Buying businesses is never easy, and building them is never easy. But we had a bit more of a leg up, or of a competitive advantage there, just given our relationships.
Okay. Well, it's also the financing, deals is harder over there. So, if you raised capital, you can acquire much easier. Isn't that the case?
Yeah, I mean, early, I mean, the cap, yes, I guess that makes sense. I mean, a fascinating thing that has occurred in private equity world is that for most of my career, that, that you needed a fund. It was hard to go buy as we grew up, I mean, that fund was, 10 the businesses were really, call it 10 to 20 million of EBITDA. That was what we were doing. And we were writing 30 to $50 million, even more equity checks into those companies. And you needed a dedicated pool of equity to do that, committed. What's shocking is I sit on 2 investment committees right now, for guys who used to work for me, and they have agreed. I was just actually just wiring the funds. They've agreed to purchase a $16 million EBITDA generator service business. They've raised 60 million US to business in the Southeast in the US. And they did this without a fund. They just raised it all through family offices and large institutions. They're not doing this on, tens and 20 grand investments. They found, large investors who would write large checks, but it's amazing they could buy a business of that scale and size without a fund.
Yeah. So when you first started, you said that first fund you bought 6 platforms.
Correct. Yep.
What industries?
It was a variety of industries. You're making me go way back in history here, which I'm trying to find, but they varied. There was a energy services business, a healthcare services business. And yeah, it's a call general. Given these businesses were 10 to 20 of EBITDA, they were real sizable. These were kind of companies that had real capabilities and more traditional. One was the biggest transaction we did was an aerospace and defense business, which was a public company we took private, and it was a hodgepodge of different things. And then there was your traditional, metal benders, your old school manufacturing companies that you could invest in before China killed them all.
Okay. And so in that first fund, 6 companies, did you buy into those companies as well? You kept doing growing them through M&A, or you just buy that one?
Yeah, that was the philosophy what was the secret sauce, right? I mean, the firm was never what we did. We were never a deal shop. It was meant to be a very concentrated group of investments. And so 6 businesses in a fund. Had we made a mistake and we ever lost money, we would have sank the ship. Particularly at Fund 1, there would be no future. But the philosophy was to be very thoughtful underwriters, do an enormous amount of work in the industries, find good businesses that were in those industries that had some capabilities. These are not like monstrous companies. There were areas where they were world-class and areas where they're not world-class. And that the opportunity for us was to improve them through governance. We didn't run them. We had good teams, but there were always areas where, they could benefit. I mean, from, what was what did we have that was a bit special? I think we had the opportunity to look at hundreds of businesses and know what good looked like. And so I always found that, we had wonderful management teams, but they'd done one thing incredibly well at one place in one industry their entire career. And were great at that, but they didn't have the benefit of knowing what else was possible. And sometimes they also, businesses require different capabilities and skill sets as they scale. And, an area where because of, where we put a lot of pressure on the businesses was the finance function, because we needed much better reporting. And through better reporting, you could sort of wring out the economics of a business. You could also do add-on acquisitions that, could create, a bunch more value. And I'd say that was really our thesis. It was find good industries, a good platform business, and then do a bunch of add-ons, not like HVAC type roll-ups, but like strategic acquisitions. We'd make a couple per investment where they were highly synergistic and we can bring in a ton of synergies and create a bunch of value.
Got it. And so what does good look like?
You mean in terms of,
yeah. So in general, at the time or even today, what does good look like to you?
Well, it's interesting. Today, what I'm doing is a bit different, right? So I'm wearing a couple different hats. When I was at ONCAP, look, if I was investing I'll say it this way: the things I'm looking at today, are $3 to $6 million EBITDA businesses that my partner and I are acquiring with our own capital. And generally, we're looking for, those are smaller companies that have some inefficiencies, and what we're looking for is something that has great cash flow, that has a reason to be, and has, some areas where we can improve it. But more, we're looking for something that has a value oriented, that we can acquire at an attractive price. Cheap isn't a thesis, but with your own capital where, you're not generating fees or you're not benefiting from the carry of other people's capital, you need to be very disciplined about the purchase price, the entry that you go in. And I think that was always the case, but in institutional private equity now, it's hard to create. If you're, my old firm, Fund 4 was $1 billion fund. We were investing that in simplistically 10 companies writing, $90 million checks. Those businesses were, typically 30 to 50 million US of EBITDA, and you were having to acquire them at pretty high multiples. And so you weren't able to steal them. I mean, Fund 1 was really about acquiring, Fund 1, Fund 2, and Fund 3 were really about acquiring businesses at appropriate values and professionalize them and using them as platforms, and then exiting them, to a strategic or another private equity firm at a much higher multiple. And that worked because there was sort of that process that was available. Fund 4 and what's happened in institutional private equity, and certainly Fund 5, which the guys are on now, there is no value. It doesn't exist. You're sort of, even the businesses we acquired that were imperfect, they had shitty systems, shitty management teams, some crappy reporting. Those businesses, you had to pay a price for all the work that you were going to do to improve it, and you would have had to pay that up front. And so what ends up happening is you don't acquire those value type investments anymore. You acquire a business that is, you may as well pay up for the incredibly awesome asset, which was not my DNA. I'm a value guy. I want to feel like, but ultimately, I think what's happened in private equity, in a lot of the institutional world now, you pay for a premium asset. With a fully functional team in place who can actually execute a buy down approach. And so a lot of that is like what you're seeing, these sort of roll-up type things where somebody pays, 13, 14, 15 times for some shitty company that's probably worth like 7. But what they end up doing is doing a bunch of add-ons and creatively to buy down their multiple. And that is sort of what firms have had to do, because there's not a lot of organic growth. There's some, but not enough. But really it's become that. And you make a bunch of investments, you hedge your bets. So it's a bit different. I mean, that's why most of my whole partners have moved on, because we're dinosaurs. We love the industry and love what we did, but we're value guys, and there is not a lot of value out there. So with my own capital now, I'm looking for value. And there's smaller businesses that you can acquire for 4 times with a lot of structure. And then we can work through and improve the reporting and upgrade the management team and do 1 or 2 little add-ons here and there. And it works with personal capital in a world where I'm not generating carry and generating fees.
That makes a lot of sense. So, what were some of the learnings that you guys took from Fund One that you took to two or two to three? Or is there anything unique that changed from the way you approach things from Fund One to two to three?
Yeah, I'd say the biggest difference, as I mentioned, Fund One was predominantly Canadian businesses,
Yeah.
and that was just the nature of our relationships, right? And so I'd say that was one thing. I think the reality is that all of us had worked and gone to school and had relationships in the United States, and all the Canadian businesses we bought, we looked at doing U.S. add-ons on, and they did have U.S. operations, but they're headquartered in Canada. The problem is, Canada's a small place, and it's not as we grew. And you think about the investable opportunity set in the country of Canada, a lot of it is energy. We did our one token energy services deal and we made 2 times our money on it. It was fine, but we wouldn't do it again. Mining, forestry, a lot of that stuff that is Canada isn't really a fit for the kinds of things we're doing. So we had to look into the United States and think about, a variety of different industries that were much larger in the US than. So that was I think one big learning, early diversification of that and building the network. And part of that happened just as we'd spent many years building businesses and looking at opportunities in the US with as add-ons. So that happened. That's one thing. I think the second thing was, we owned a couple of manufacturing businesses in Fund One, and Fund One was like 2000 to 2005. Think of it as that time frame. And that was just before this country called China sort of showed up on the scene and vaporized the manufacturing world. And so a whole bunch of the companies that we invested in Fund Two were actually distributors. And what they ended up doing was, effectively having a brand, having a product, had something that was manufactured overseas. And what we would have the IP, we would design it, we would manage the customer relationships, we would manage the supply chain, but ultimately, the real manufacturing process occurred, overseas, and that made sense. It was just a lot cheaper. They were better at it, and it was a better cash flow business. And so that was something that happened in Fund Two. That was just a change. That's one of them.
But that's a big organic shift that happened during that period of time. So I literally was in that ecosystem where I was a manufacturer and then I became a distributor and went to China. So I did exactly what you just said. And it was exactly in that period of
Yeah, and
time.
that was the window. I mean, we
Yes.
thought we just had to think about, okay, we can't touch, not that we can't touch, but we would
Yeah.
see all these crappy Canadian and US, manufacturing businesses that we knew were not going to be great long-term investments. And so that was, I would think that was one change. I think the second change was we got a lot. The Fund One was a handful of strategic acquisitions that the businesses we acquired. So the add-ons were less frequent, but were more strategic. There were fewer of them. Fund Two, we got very comfortable with roll-up type, I'd say smaller type opportunities. So, if I think about Fund Two, we bought the largest car wash business. This is 2006, so that's our flavor of the day now. But there's a business called Mr. Car Wash, which is a public company in the United States now. We're actually the first investors in it. We bought it. It was a $10 million EBITDA business. It had two markets, Minnesota and Houston. That was it. And the biggest risk with that kind of business is weather. And if you have a shitty weather season, it can really impact your return. So you diversify that through additional markets and you diversify through the revenue base. But that became a really interesting roll-up type opportunity where, we were acquiring, and we did, I may forget my numbers. We might have done 25 add-ons with that, but they were small, but that was a bigger part of it. We also did that in collision repair. We own the largest collision repair business called Caliber, which I think now is like an $800 million EBITDA business for all I know. We sold these like a decade ago, but those were, the kinds of things that were almost multi-location consumer facing businesses. So if I think about like Fund Two, it was car washes, collision repair, restaurants, casinos. There was a lot of that. And then we had, a couple other distribution type opportunities and some other stuff. But I'd say that was probably the biggest shift, if I want to think strategically.
So in that fund too, which segment was the winner, the top, and then which one was the kind of like the one that was the drag on the fund?
I'm just trying to pull it up. I mean, you know, the the biggest winner was our car wash business. We made 8 times our money on that. The worst was a restaurant business. We made 2 times our money.
Hmm.
It was only 8 businesses in that fund, and that was the philosophy of the way that my old firm we did things, right? I mean, we made a handful of investments. They weren't meant to be diverse portfolios. We only had, we had 4 people for fund one. Maybe that grew to 6 or 7 by the end of fund one. Fund two, we might have been up to 10. So we didn't have a huge team, right? There was a couple of us partners, a couple of junior resources, and you can't be a good partner to the companies. And we didn't run the operations, but we were very involved in governance. And what does that mean? A lot of these businesses didn't have great reporting, great systems. They're creating the proper dashboard and making sure that got put in place. Obviously, upgrading talent, which was not, which was for any C-level hires, CEO, CFO, COOs, we were super involved in that. And then the capital side, which was the add-ons and the plant expansions, anything required major CapEx, like a facility expansion, we were all on top of. And that takes, you can't be a good partner and be a good steward of a business if you're on the board of too many companies. So our philosophy was to have fewer businesses that we would be very close to and that we would drive pretty hard. And it also made us a bit paranoid, right? And that probably cared. Had we lost, we made only 8 investments. Had we lost money in any of them, we'd sink to shit. And so, the industry changed a bunch, but our philosophy was always fewer businesses, longer hold periods, be more thoughtful and more hands-on. I can't speak on behalf of the entire industry. I've met a lot of, of my peers who ran other firms who sat on like 10 boards, and I don't know how they could have done that. It's bullshit. I actually don't believe they knew they were really good partners. You can't be if you're on that many boards. And also the philosophy may have been a bit shorter term. We weren't aiming to make 2 times our money on an investment. We were really aiming to make 4 or 5 because that's how you get rich, right? It's dollars of profit. It's not IRR, but it was, that takes time. That doesn't happen in 2-3 years. So the nature of it tends to be longer term, fewer assets that you sort of like plant your trees, nurture them, grow them, prune them. And then ultimately, if things go well, you look to exit them.
Makes sense. And at this time, you're running both fund 1 and 2 at the same time, right? Because you haven't fully exited. Okay.
And yeah, it takes time. I mean, look, you never fully. I think I just got a distribution on a business that we bought in Fund 2 in 2006, an environmental services business. My firm owned it. My old firm owned it 18 years. It happened last year, and it was actually it was not. It was I think the firm made 5 times the money, but that's like a 10% IRR.
Correct.
I mean, that was like 12%.
Yeah,
it's a long time frame, but I always said that those were the kind of investments. Look, that was a testament, I think, to my old firm. That business went through probably 5 CEOs,
wow.
4 or 5 different pivots. A whole bunch of stuff happened. I mean, and so while the firm, never lost money, it wasn't like everything was up and to the right. We had a shitload of problems at all of our businesses. That's the nature of being an owner and involved. And I was always really proud of what my old firm and what we did to protect value.
Yeah.
And to sort of make those tough changes, because that I suspect a lot of other firms just would have moved on. They would have just taken a mediocre return, or just let it go. But that was, we never, and I don't know how the guys will do it going forward, but the philosophy, at least when I was there and the others were there, was we can't lose money.
Don't lose money. So the environmental services is a good business. So what was the problem?
It's a bit different. It was a bit different, and it's not a garbage collection business. It was a soil remediation business. It had a consulting business, and then there's like low tech. If there was think of like a gas station, the underground storage tank leaches into the soil. You need to remediate that.
Yeah.
And so we would either do that on site or bring it to our facilities, and then you add a consulting business that was onto it. And then it became almost a consulting business doing some projects. And so there was a lot that kind of happened over the years with that, and you had some lumpiness. There's a lot of pivoting, right? I
Is
mean,
it because it's related to real estate? It was impacted by that, or is it just not? It wasn't it's not an industry thing. It's the specific to that specific
the
business.
issues with that one, at one point, this is a long time ago, and it's changed a lot.
Yeah.
The issues we end up having is effectively it was a recycling business, right? And you think about soil recycling. And so we got into some other recycling type things like organics. And so what ends up happening in certain markets is that we have it here as well. In Florida, you have these programs and they take, your blue bin, your plastics, your glass, and your organics. So we had a bunch of those contracts, which are pretty shitty, uh,
Mm.
because they become municipally bid, and it's hard to make any money, and you end up taking, some risk. So that was a part of what created some of the problems, combined with, a management team that, was, not economic on some of the contracts they took on.
Got it.
That was one
Okay.
part of it, and then we got into a bunch of other stuff. But it was, and then it got split up. I think the business became split up into a couple different parts, and one became a facilities-based, uh, soil remediation business. The other side was a pretty interesting environmental contracting business.
Got it. Okay, that makes sense. And then so what was the transition in Fund 3? Where is the learnings in Fund 3?
Um, I I was trying to think through. I mean, the thing is, like, the crazy thing about, our investors, whenever we raise money, they would always, come and say, "Look, what is your strategy? What is your thesis?" And the reality is that we would do an enormous amount of work on a bunch of industries. But at the end of the day, we could only, it's not public market investing, right? If there's no transaction, there's nothing to do. You can't. So I said, like, the businesses we're going to acquire. It doesn't mean we were totally opportunistic, because you couldn't be. The market became pretty competitive, but you could never say at the beginning of a fund. It was always interesting to us as partners when we look back at the end of a fund to realize what we invested in. All the businesses were market leading, great cash flow businesses with a professionalization thesis and sort of an M&A thesis. And the businesses were all, looked and smelled the same in terms of some of that high level stuff, but the industries were all over the map. And it was partly, you learn and you study, and that was the fun part about what we did. It was used to call homework projects, and you would start to think through, okay, where's a business, a sector we haven't looked at? You run around the planet and you try and just meet executives and meet companies and see if there was something there. And we spent time in, like, logistics, chemicals, beauty, like, just everything, we covered over the years. And sometimes there were, the sector sucked. Sometimes they were great sectors, but there was nothing for us to invest in. Sometimes they were great sectors and there was stuff to invest in, but the prices didn't work. And so, for Fund 3, I'm just kind of looking through the businesses we bought. I'd say probably the more interesting change that happened there was we got a bit back. It looks like the firm got a bit back more into industrials. And I think that was part of scaling. And because there was it's hard to buy. I mean, look, the businesses that my old firm acquired were all market leaders, but they were small markets. Like, these are like $25 million, like, they're not billion-dollar businesses that dominated, the world economy. So by definition, if you're a market leader and you're a $400 million revenue business, it's a pretty small market.
Yeah.
But as we got a bit bigger, because Fund 1 was 400, Fund 2 was 6, Fund 3 was 800, we started looking at some bigger businesses, and we could be able to acquire niche manufacturing businesses that were at least we reached the size where we could acquire businesses that own the market. And so the big one was like businesses like Davis Stanley, which made extrusion capital equipment, so extrusion machine. We would make all the machines, and then we have the parts and repair stuff. We then did a bunch of distribution businesses, but they were different types of distribution, like kitchen gadgets, where we managed. So you could think about it like, we had a business that managed effectively the entire supply chain of kitchen gadgets, bakeware, and cookware through most of the U.S. grocery. And that business, we would source design stuff, sources in China. We would have branded or private label or licensed, and we would manage that across. And then you would thoughtfully acquire you get into, um, cleaning products. You got into other stuff on the shelves that were a fit. And so I'd say that was probably the bigger transition. It was a bit more industrial, a bit less consumery, a bit more technology oriented. There's still a fair amount of multi-location, type roles. I'm just looking. We owned hair salons. We owned a large tire repair business, in Mavis Discount Tire. We had some casinos, which was Fund One, Fund Two. We had an automotive aftermarket business that was really a retail business. So I'd say that was following we owned a roofing business, commercial roofing business, which was a building industrial services company. It was a neat company because most folks thought of that as a very cyclical industry, and always a large part of it was pretty stable. There was always a maintenance component to the re-roof, and so that was a big study that we spent. I mean, a lot of what we did was take industries that people perceived as not interesting or could be more cyclical, like auto or like aerospace or like roofing, and think about how do we play this in a way? How do we play the installed base versus the new deliveries? And that was a thing that I think my old firm did pretty well.
Interesting. So I have so what starts first? Is the deal flow and then the studying, or the studying first and then you go, because obviously you can only like look at the stuff that's available. So
Yeah, it was mostly, I mean, once you at this point, Fund Three, we've been in business for, 12 years. And so
okay.
there were a lot of the phone always, I used to always say to my old colleagues, I mean, it's like a snowball. Every day we're adding critical mass. Every day somebody new was being touched, or met by the organization. I mean, a career in mid-market private equity, you're never home. It's not an inside job. I mean, that's why I don't do it anymore, because I basically was like sleeping in different hotels in different cities for 20 years straight. But it's a job, I used to always say you got to make the phone ring,
Yeah.
and so you don't do that just sitting on your ass in some office in New York or Toronto or anywhere. And you need to be out there, and particularly the businesses we were investing in, they weren't really located in like major cities. But no, I think a big part of it was, we would think about uh, the industry first, and then there became an ecosystem there, for us to sort of navigate that. It became a bit more professionalized, but typically you decide, okay, we want to do more in consumer products. So you start off, you think about, okay, what are all the consumer products? You study all that out. You then find the bankers. In the US, there's bankers for everything. There's like guys who do housewares, guys who do like, pots and pans. There's guys who do cleaning products, and you go talk to them and get on their radar. And so at least you could start, the holy grail was finding proprietary opportunities where we could not go through auction processes, but you got to create the flow. So you let those folks know. Then you'd always find an executive. You kind of bounce through the ecosystem. You find some river guide, which is what we sort of called them, some guy who ran like a giant business who doesn't want to run a business anymore, but wants to work with a private equity firm to buy a company and sit on the board. And that was a big part of it. It was that, and then that was on new things. And then there were all the legacy things that we had done previously that were tangentially close to new sectors we were looking at. I mean, we own distribution businesses in sporting goods, kitchen, housewares, auto, uh, missing another, industrial kind of abrasives. And so all those are different, end-to-end segments, but they're all the same business. They were all, and it was all the same business model. And so you could sort of navigate through understanding business models. There's only a handful of types of business models really out there, at least the ones we were comfortable with. And so even though it was a totally different industry, you sort of knew that all the main questions and the main economic drivers that would drive those, you could figure them out pretty quickly. But as the market got more and more competitive, you can't just show up uninformed.
Yeah.
We were pretty good at, getting smart on the things that we knew. We would never buy the first business we saw. By the time we acquired a business, we looked at acquiring almost everything in the industry. I mean, we would go to a ton of managers. That was the beauty of what ended up happening in private equity. We would see, 6 to 800 deals a year, that were relevant. That excludes all the bullshit like startup-y type crap. And we would go visit, 100 companies a year. And so you think about adding that up over 20 years and over a time frame, you end up, having a pretty good nose for what has happened, particularly later. It was amazing. When I was my last few years, you'd start seeing these like books on opportunities, that were for sale that you'd seen 4 times before. We could just go back into our records and find, like the 4 CIMs of those books that have been sold over the 20 years. It was always hilarious to see, you know, I mean, we could show up incredibly informed because you would sort of watch 4 movies before you decide whether or not to go to the 5th and maybe enjoy it.
Yeah, that's interesting. And so you mentioned business models, a handful of business models. How do you describe those handful of business models? If you go like, let's say the top 3 that you liked.
Well, we like distribution broadly. Just it eliminate and that depends, but you have to find because there's a lot of distribution. Businesses are just box movers. They add no value, right? And so what do they do? And that's a shit. Those are real estate plays, right? They're better to
Yes.
own the building. So we like businesses that were value distributors that own some IP. And it was really about the supply chain. That was because we owned that we were comfortable with that business model in a lot of areas. We like multi-location consumer-facing businesses. And so casinos, collision repair, car washes, certain restaurants, hair salons. Those you have to be thoughtful. You need to make sure they have a reason to be and they add some value because the labor side can be incredibly complex. And that's going to be actually pretty interesting, I think, in the future. It's not something I would. If somebody out there I think this could be a very interesting time to acquire a franchised, like a pocket like Wingstop or something like that. Some business with because you'll be able to take the labor out. All this shit's going to be automated in the future, and the economics for those could be pretty good.
Yes.
So that's I'd say that, and then the other business model that we really liked was that selling and they could be a bit lumpier, but they were almost like these industrial equipment businesses selling more complex machinery and equipment like extrusion equipment, and then thinking through how we can get more revenue from the parts and maintenance side. So that was sort of that installed base, type thesis, which was you're almost selling the staplers, so you can sell staples.
Yeah, the subscription. Yeah.
Yeah. They're not really subscription, but
Yeah. But
it was
by having the machine, that's the subscription. And then
yeah.
and then you're buying the parts and the maintenance.
Yeah. So I think that was just a part of it.
Yeah.
We didn't do a lot of healthcare, which a lot of folks like, probably because there were firms out there who were so smart and knew it so well. We looked at tons of them, and I think we did low tech healthcare. I think my firm bought a dental business finally after looking at them for 25 years. But there were just that's like consumer healthcare, but like true healthcare with the stroke of the pen risk, like Medicare, Medicaid we just weren't smart enough or well connected enough to do that kind of thing. And remember, we were looking for cash flow, more stable, probably lower beta businesses that had a reason to be. And so while they may not, you know, like for us, we just didn't really believe a lot in organic growth. It was possible. We felt like most businesses probably are going to grow a couple percent a year. And that's kind of what we underwrote. So we were the right buyer for those kinds of companies. If somebody believed something was going to grow 20% a year, we just wouldn't be competitive. So we sort of stayed in lanes where they were a bit slower growth businesses, but they had a presence, a reason to be. They weren't going to get knocked off because we were more concentrated. We were making like 6 to 8 investments per fund. And then our trick was, how do we accelerate the growth now that we own it? Let's pay for a slower growth business. It's not a no growth business. It's not a high growth business. But how do we change the trajectory? So a large part of that was M&A. A large part of it was upgrading management. A large part of that was investing in sort of better marketing, better systems, some sort of approach to the marketplace. And that was a big part of what we were trying to do. So we could change the multiple of the company, right? You change multiple by making a business bigger, change multiple by diversifying it so it's got less exposure. You change multiple by changing the growth rate. And so why we always felt like let's acquire a business at an appropriate multiple, and then at least had the opportunity for multiple uplift. I never wanted to pay, a crazy ass price for some business that you had to believe was going to be perfect forever, because no business is perfect forever. Think of I don't know who's on this Zoom or the backgrounds of people, but like we never did software, not because we're geniuses, just because we weren't smart enough. But all my software smart VC guys won't touch a lot of software businesses right now because they think they're all been destroyed by AI. That's not that's about as much as I know. It's really because I'm totally an idiot when it comes to this kind of stuff. But we just felt like shit can go wrong. Let's make sure we really get our ingoing multiple correct. We weren't stealing companies. We were paying an appropriate price. And then let's figure out how we can change the value of it and make sure we can change it up. But at least if we shit the bed and we don't do our job, it's still worth 6, 7 times. That was sort of how we thought about investing.
So essentially the value add that you were doing was, A, M&A, B, change management, C, change the trajectory of growth through marketing and through a different approach to positioning the business.
Yeah, I would say that was probably, those were all of it. I mean, at the end of the day, and we had great management teams. We had the benefit of having looked at a lot of different companies, a lot of industries. And so had a lot of ideas, and they weren't all great, but they were ideas for people to consider. We felt like our job was to create just a menu, and let's make sure we have a large menu. And then we need to figure out what do we want to execute on? Because I find when businesses try and do too much, they don't do well. But let's at least have a large funnel of ideas. And then we could pick the 3, 4, 5 that are the most important things we're going to do in the next 5 years. But so that was one, introducing ideas, new blood, new ideas. I think the other thing that was, I used to say, like, we didn't really create a ton of value as owners in terms of like amazing ideas. What we did do was stop stupid decisions. I think most of the value we created in our businesses was not the things that we did that created value, but actually stopping decisions that would have destroyed value. Because we were pretty analytical on everything that we did. We didn't have to run like a whole memo RFP process to buy toilet paper for the bathrooms, but any major decision, it was people, process, acquisitions. It was, it was probably a pain in the ass for our management teams. But it was important, to have a process to make better decisions to reduce poor outcomes. And so that was ultimately a huge part of our value add, which is creating a governance process where decisions had to rise up to the major ones. We didn't need to get involved in minutia, but we create a process where big decisions would float up to the board and us, and it wasn't just a board meeting. And then we would create a process to really think through. And then once we decided, we were all good. We would go forward. But a huge amount of my job as one of the guys running the firm was delivering bad messages, and those bad messages tended to be, "This is a stupid idea, and we don't support it," because but we would go through it wasn't based on gut, but we would go through a process to figure out why that wasn't a fit, and that was ultimately educational, I think. And maybe we were a bit conservative on some of those things, but that was the way we were wired, because we I think we approached most things from thinking more about the downside than the upside.
Yeah. Well, because you had constant
style. There's a different style every type of investor. I mean, we were more downside focused than upside focused. And other investors are wired differently.
And Jay, is there an opportunity for us as sort of participants to kind of get involved and ask questions, or is there more sort of
Go ahead, yeah.
And Mark, thanks a lot for all of this. I was sort of banging around and not on video for the first part of the call, but my name's Stoney. Really appreciate all of this context. It's just so
powerful. But no, anyways, no problem. I didn't know what was going to get asked or what I was doing or who was on, so I'm just kind of rambling.
Thanks for being so transparent and so sort of really sharing. It's really great, and I think all of us sort of in this zone of looking at buying sort of smaller style businesses. And then, but I also come from a background. I worked at Macquarie for many years, which you'll be familiar with. And then now have my own little merchant banking business and looking at sort of opco, propco style deals, but really on the small end, right? South Florida, trying to be local, probably property management and that sort of thing. But my question, I guess, is as you go from this much more institutional world where you really can create these moats in having libraries and information and processes and people and underwriting and sort of this, wonderful web, that you can create with the resources, how have you found it in terms of operating on this much smaller end of the scale? Is it that do you find that there are where is the happy hunting in terms of the assembly of ingredients? Is it like these industries would have been not interesting at the sort of big boy level, but are interesting at the small time level, or where there's, particular areas that you find where there are inefficiencies, the small level? And then,
Yeah, I would
and then
say
whether there's also business models that are more relevant as you're thinking, 5, 6, 7 EBITDAs.
yeah, I think it's become it's into look, so um you're always learning, right? I loved what I did because I've learned so much. I just didn't want to do it institutionally more because I frankly wasn't learning as much, and I think I was frankly just a bit bored. Um, However, where I'll go with that is that there were a whole class of companies that we used to see at ONCAP that would have been. I remember myself, my old partners were like, "This would be awesome to do personally," but it's just but we can't do it through the fund, and not because it was like illegal or or something like that, but it was more it just wasn't it didn't have the right growth trajectory. It had some blemish, some concentration issue, something that you actually could solve for. And you could, but you felt like our bar was we're going to look at any given fund. If you think about it, it was 600 to 800 deals a year. Every fund was 5 to 6 years. So we look at 2,500 to 4,000 companies over the duration fund, and we would acquire 8. And so there was a lot of stuff that just the bar was incredibly high from the things that we were going to put in the fund and allocate time and energy to. But there were these businesses, and that's where I'm going. That's a little bit where I'm looking at now. Those companies that are interesting for long duration, super long duration, personal capital. So my partner and we're fortunate. It's just our capital, no outside investors. I had one rule after I left OnCap, which is I never wanted to manage third-party money again. It's an honor. I think I was better at my job.
No, I feel you completely.
But I actually think I was better at it with other people's money. Like I do think that
it does sort of impose rigor, doesn't it? The fiduciary responsibility, and that's something I'm thinking about as well.
Yeah, I thought it through. Like I do think I'm not cutting corners, not being lazy, but there is a process that's imposed in a a bit less sleep caused by me, and I choose to do things at 98% effectiveness and sleep better at this point in my life than do 100% effective with a shitty sleep. But
I'm trying to move that direction. We'll see if we got there.
But so there were these businesses that you would see that would have some long term. You knew they were just going to be wonderful cash flow assets over a long time frame. You knew they were interesting return on investment opportunities through over a cycle. But they were never going to be the fit for a 5 to 10 year holding period. And so that I'd say that's sort of the areas I'm bouncing around in now. It's been interesting learning. I'm not trying to see. We've bought 2 garden plant businesses. We own and my partner and I think of these as consumer products with the enormous amount of real estate.
I've looked at a few of those sort of nursery style businesses as well and gone, wow, this is just like a covered land plot on something that's ultimately a development site,
It is, but they're shitty. They're not fit for institutional capital. You have, you have customer concentration, you have like seasonality risk, you have some disease risk, all this kind of thing. But for 2 guys with their own capital who can acquire some things incredibly cheaply with an enormous amount of structure and a covered land play. And then we think of them as high yield bonds. And so they're not perfectly well managed businesses. They're not dummies. Like these people like our management teams are great, but you can sort of crank the coupon up over time through adding a couple new stores at Home Depot or Costco, creating a Christmas line, which we've done in one business to add a bit more revenue. And so there's some things you can do to crank up the aggregate sort of coupon dollars, but then through operational improvements, you can actually crank up the coupon rate through just being a bit more thoughtful on the inventory cycle and on some of the things that they're doing, particularly on logistics. And so you sort of tile it in. There's no way like these companies are ever going to get sold to some private equity. They're never going to be 10 times assets.
Yes.
But they're really interesting. As an example, that's one example. I'll give you another example in a minute. They're just interesting. And the way you can acquire these things, because they're real estate based, you can effectively finance them like a real estate play with a giant mortgage, right? And so you can actually get more leverage than would ever otherwise be the case for some traditional business. And then, of course, because it's like a $4 or $5 million EBITDA business being sold by some entrepreneur, you can use all the shit that I used 20 years ago that I was not able to use in my career ever again, like earnouts of VTBs and all the bells and whistles that just got held by the efficiency of the market. So you're able to effectively acquire these things, with not a bigger, without an enormous amount of your own capital. It's a pretty interesting structures and improve them over time. And ultimately, if they don't work out, you turn them into houses, like real estate.
Yeah.
And so that's kind of the kind of thing, but there's no private from the plants ever going to buy these things. Like I know my old, these things are garbage businesses, but they're wonderful for a couple guys with like 30-year capital who can generate an amazing yield. And in a marketplace where we can acquire, like we're just looking at another one right now. So, two sort of in the GTA, like around the Toronto area, we sell into the US, and these fucking tariffs are fucking everything up. But, and so we need to add an operation in the US. We're looking at one kind of in upstate New York right now as well. And of course, and I am looking for one in Florida because but that's one thing. The second type of business I would describe that we spend a lot of time looking at are dealerships. And so dealerships are effectively quasi little monopolies, which are tied to your own. And I'm talking, we've looked at, these are the most Canadian things on the planet, like Skidoo dealerships, like, snowmobile type dealerships. We've looked at marine,
But we've got Sea-Doos down here. Maybe it's similar.
yeah. So, there are this kind of businesses that, are real estate intensive. And now I'm a bit skewed because I still have an enormous amount of capital tied up. Like it's going to take 15 years for me to get all my money out of ONCAP. And I'm fine with that. The guys are great at what they do, but I still have a large traditional private equity exposure of like $15 to $50 million North American EBITDA businesses. So I'm not really looking to duplicate that. And I'm interested in things with a bit of that covered land play, as you described, real estate bed. And in more cyclical type companies, a cyclical industry, you can actually, I'm okay with cycles with a long duration and the right capital structure. And so you can acquire things pretty attractively, like cyclical businesses. When you find somebody who's really going to vend, you can actually find great value. You just need to make sure you have the capital structure to withstand it. And we don't use a lot of leverage. And that's sort of how we're connecting the dots. And my partner owns a whole bunch of truck dealerships and trailer dealerships. And so we are bouncing around looking at some kind of unique, industrial type dealerships, which come with, an interesting cycle, some stuff we can do on the parts side, because we think a lot of these businesses don't manage the parts side very well. And there's also a lot of these organizations more broadly are not interested in having institutional capital. So you're not competing against private equity guys. Like, the John Deeres of the world don't want a bunch of private equity guys running around rolling up their dealerships. And so you can acquire, they're looking for long duration, sort of holders. And once you're in that ecosystem, you can thoughtfully assemble a few more. Now these are not these are like super long duration. They're not sexy 2-year investments. They're not like all that shit. But you can own them an incredibly long time and yield beautifully and get something done with them.
Thanks for that comprehensive response. I know
That's really good.
I Jacob, but thank you.
No. This was great. What's one of those good structures that you like for cyclicality?
The way you solve for that is purchase price leverage, right? So that's the leverage you really have to worry about is your bank leverage, right? And it's third parties. The leverage from the owners, every VTB or seller note or vendor take back note I've ever done is a bit structured, right? So ultimately it'll get paid back, but you can make sure that you tie a performance component into it. And the performance component is not like you won't get paid. The performance component is I will not pay you if the business doesn't achieve a certain threshold of earnings for a time frame. And so and then you have earnouts, and earnouts are obviously tied to performance. And so if the business cycle's hard, you just don't pay it. So there's a lot you can do with the vendor's capital to solve for cyclicality. The thing you have to worry about is the bank.
Yeah.
And my partner and I are not interested. Like we're basically doing things with mortgages on the real estate.
Got it.
And that is like, you have a DSC, like you don't have a lot of covenants in there. You've got and you can structure it in a pretty thoughtful way. The amortizations and all that, it kind of works.
Mark, you made the comment, businesses that have a reason to be 3 or 4 times in the presentation. How do you define a reason to be? And then more broadly, how do you define a business that doesn't have a reason to be? Like, what are some examples maybe you've seen that could be a trip hazard for somebody?
Well, I mean, I think in a world of everything's changing so much, like reason to be is it's hard to guarantee things in perpetuity, which is maybe why the assets, work a bit more. I think reason to be, I always thought about capabilities. Um, so was there a either an asset base or a capability base that was somewhat more difficult to replicate? And now look, they're not all like incredibly, super technical IP, but I always feel like how hard is it to create this business? How difficult is it to do this? What is that? What would somebody have to come up with from a capital, or from a capability or from a labor standpoint? And how hard is that? Because you're really thinking about particularly smaller businesses, like how difficult is it for somebody to like enter your marketplace and disintermediate you? That's one thing. I think one thing I've never liked, and which made me a shitty consumer investor, I think brands are not sustainable. And so I don't think a brand is a reason to be. And I think a lot of these business models that are tied around brands on the consumer side or a certain product side, we spent a lot of time, my old firm, talking about this, which was, what is their true capability? What makes them special? Which is we actually like businesses that like our consumer businesses would do private label store brands. They would do our own crappy store brands, and then we would do licenses. And we just basically would manage the shelf space. And if Target or Kroger or Walmart was like, you know what, we want to have our own brand now, like we're done with other people's shit, we'd say we can do that for you too. We'll just like we'll manage the supply chain for that. Then the fight would be over margin. But at least you wouldn't get kicked out instantly. We could continue the conversation, and then we could figure out a way to over time margin our way back up. And so that was a capability versus I'm trying to think of like other, like I just spent zero time in technology, like software. So I'm just not, I don't know enough, to be honest. We were too cheap, weren't smart enough. Maybe because began my career in the dot-com bubble and I'm just terrified by tech stuff. Um, I, I'm just, I can't, I can't answer a reason to be or not reason to be as it applies to like software or technology related businesses. I think a lot of businesses need to have a physical presence. I really think that's an important thing. Um, could this business disappear? We've looked at some automotive dealerships. They're good businesses. The problem you can kind of have with them is how does that change, right? If you move to a world of self-driving cars, and also even if the whole world goes EV, what does that do to the sort of repair and maintenance and the models? Like it's just, and I'm not smart enough. There's just too much change there. Like you probably need a dealership, but maybe you don't. Like maybe in the future, like we never go to a dealership again. Nobody owns cars. You just kind of like, use your phone to bring them in and out. I don't know.
Yeah.
So that,
or the car will drive itself to somewhere to get fixed and come back.
yeah. So I would say I'm a bit opportunistic at this point in my life. I'm not running around. I will do a bit of this in Florida because there's some fun and sport in it for me. But I'm not running around Toronto trying to see every $2 to $6 million EBITDA business, because a learning I had in my whole life is I was on way too many boards of way too many businesses all over the place, and it sucked. And I'm going to spend time in pretty concentrated ways. We've got a couple, businesses in the horticultural space in Canada. There's some stuff I do with a couple private firms. I'm on boards of some of their businesses, but I think of that as more transitory. And then what I really would love to do is find an asset in Florida, which is where a fun life for me would be the life I have in Toronto replicated here in Delray or like this broader Florida marketplace. So I am bouncing around trying to think about how I could get involved with the business as an owner. I don't want to run anything, but as a pretty hands-on owner, brings capital, some capabilities, and just be fun, build it, work on it for a long time, create some value. It's fun, get into the marketplace. That would be, that is a goal for me, and obviously how Jay and I connected.
Well, on that note, I appreciate you, Mark. Thank you I think we probably could talk for 3 more hours.
I feel like I rambled a bunch. I don't know if this is great.
This is so great, really great. That's
No, I saw your note taker. You can just edit and make shit up.
no, it was perfect. And we didn't get to Fund 3 and 4 and whatever, but it's I think we should do it again. I appreciate. What are you looking for right now in South Florida? So it's just so we can keep an eye on.
Look, a couple things. So it starts off with life's better with a partner. I could do things on my own, but it's fun to have somebody to look at things with. It's just more interesting. So that I would say the things was I have a wonderful partnership with an individual. He and I could do stuff here at Florida as well. But it's fun to have somebody else to kick shit around with, right? So that'd be one thing. Somebody with some capital, capability, and interest in working with a business in a similar philosophy. And the only way to figure that out is you look at a few deals together and you figure if you see the world the same.
Yeah.
Always said that to people. Like you don't just partner with somebody. You look at some stuff and you look, do we learn from each other, but do we think enough the same such there won't be problems? So that's one part of it. I think in terms of assets, we do have this aggregation of horticultural businesses. So a greenhouse business that has a standalone team and capability, call it, it could be a bit smaller, but like I'd say probably 1.5 to 3-4 of EBITDA, because it could bolt into the stuff that we have right now. That would just be I wouldn't call it add-on, but it would be part of our aggregation of stuff that we have.
Yeah.
So that would be an interesting specific opportunity. And then the other thing is I'd say more generically, call it, 2 to 5 in consumer-ish products. There's a bunch of stuff in Florida. The economy is a bit different here. But consumer products or consumer services or something, it's easier to describe what it isn't.
Yeah.
It is. And a lot of it will come down to the people, the partner I do with, or the business and the team. Because I'm not an operator. I know I've been around a lot of it, but I wouldn't know how to run a business very well, and I don't want to. So I need something in something in place that could have a reason to be and something to do with it. And that's very generic and sounds totally stupid.
No, it makes sense.
I'm purposely being very broad because I want to open the aperture. I didn't want to be so specific, because if you're too specific, then nothing happens.
Well, and I think that's the way to do it. And that's what we talk about all the time as well. So I appreciate it. So I appreciate you taking the time, Mark. Hopefully I'll see you soon. And
yeah, anybody, whoever's out there in the interweb, feel free to email me. You've got my email, and it'd be fun. Yeah. And if there's ever any way I can be helpful, I don't know if I can, but
absolutely.
I'm enjoying this new phase of my life where it's fun to be just a guy with the Gmail address bouncing around.
Nice.
May reach out.
Email is underrated.
Or whatever it is, but
I just remember this drive.
We're gonna grow, so
oh, perfect. No, I'd love to. No, it's fun. I'm enjoying this, very understated Gmail approach to it. Even though I've got a bunch of fun stuff going on, it's kind of fun to be open to, and just have new, fun, interesting conversation. I didn't know what the hell to expect chatting with you, and I didn't know what to expect on this call, and that's kind of fun for me at this point.
That's awesome. Cool. Well, thank you guys. Thank you, Mark.
Thank you.
Appreciate it.
Thanks, guys.